Ever wondered how people make money from the stock market? It's not a secret club or a hidden treasure map. It's a skill that can be learned and a process that can be understood. The stock market can be a powerful tool to grow your wealth, but it's not a game of chance. It requires knowledge, strategy, and patience. From the outside, it may seem complex and intimidating, but don't let that discourage you. It's like learning a new language. Once you understand the basics, the rest will follow. This video will guide you through the fundamental steps of trading in the stock market, from understanding what stocks are and how they work, to making your first trade. Whether you're looking to supplement your income, save for the future, or simply want to understand how the financial world operates, you're in the right place. Ready to take the first step into the world of stock trading? The stock market isn't as complicated as it seems. Let's begin by simplifying this concept. At its core, the stock market is a supermarket, but instead of groceries, it sells pieces of companies. These pieces are known as stocks or shares. So, when you buy a stock, you're essentially buying a small part of a company. Now, why would a company want to sell parts of itself? The answer is quite simple: to raise funds. Companies sell stocks to generate cash, which they can then use to grow their business, launch new products, or pay off debts. It's like a trade-off. They give away a slice of their ownership in return for some much-needed funds. But what's in it for you, the investor? Well, when you buy a stock, you're not just buying a piece of a company, you're also buying the right to a portion of the company's future profits. These profits are often paid out to shareholders in the form of dividends. Dividends are like a thank you gift from the company for investing in them. It's a portion of the company's earnings distributed to shareholders. But not all companies pay dividends. Some prefer to reinvest their profits back into the business to fuel further growth. As an investor, you'll need to decide what's more important to you: immediate income from dividends or potential future growth. But remember, buying a stock doesn't guarantee profits. The stock market is a bit like a roller coaster. Prices can go up and they can come crashing down. Your goal as an investor is to buy stocks when prices are low and sell when they're high. It sounds simple, but it requires careful planning, research, and a bit of luck. So there you have it. The stock market, in a nutshell, is a marketplace where companies sell parts of themselves to raise funds, and investors buy these parts in hopes of turning a profit. Whether you profit through dividends or by selling your stocks for more than you paid, the goal is the same: to make your money work for you. Now that you have a basic understanding of the stock market, let's move on to how trading works. Buy low, sell high. Sounds easy, right? But there's more to stock trading than meets the eye. Let's break it down into manageable steps. First things first, you need to open a trading account. This is your gateway to the stock market. You can do this through a brokerage, which is a firm that buys and sells stocks on your behalf. There are plenty of online brokerages that make this process pretty straightforward. You'll need to provide some personal information and, of course, an initial deposit to start trading. Once your account is set up, it's time to choose which stocks to buy. This can seem overwhelming given the vast sea of options. But don't worry, you don't need to become a stock-picking wizard overnight. Start by considering businesses you're familiar with and understand. Do some research. Look at the company's performance, its competitors, and industry trends. Remember, knowledge is power when it comes to stock trading. Now comes the exciting part: placing a trade. You've done your homework, picked your stocks, and now it's time to buy. To do this, you'll need to place an order through your brokerage. You can choose to buy a certain number of shares, or you can invest a specific dollar amount. Once you confirm your purchase, congratulations, you're now a shareholder. But here's where timing comes into play. The stock market is a complex beast, and prices can fluctuate wildly from day to day. The goal, of course, is to buy stocks at a low price and sell them at a high price. But timing the market perfectly is near impossible. That's why many traders use strategies like dollar cost averaging, where you invest a fixed amount regularly, regardless of the stock price. This can help smooth out the highs and lows over time. Remember, successful trading involves careful planning and strategy. It's not about making a quick buck, but about investing wisely and patiently over time. So take a deep breath, do your research, and start your journey in the stock market. Stock trading isn't a guaranteed route to riches. It's essential to understand that as much as the stock market offers an avenue for wealth creation, it's also a platform where one can incur losses. When you invest in a company's stock, you're essentially betting on the company's future performance. Stock prices rise and fall based on a myriad of factors, many of which are beyond your control. These may include the company's earnings reports, overall economic conditions, and market sentiment, amongst others. If the company performs well, the value of your investment can grow. However, if the company's performance dips, so does the value of your stock. This is the risk you take as an investor. In a worst-case scenario, a company could go bankrupt. If this happens, shareholders are usually the last to receive any remaining assets after creditors and bondholders. In such a scenario, you could lose your entire investment. On the flip side, the rewards can be substantial if your investments perform well. The stock market has been a proven avenue for wealth creation over the long term. When you invest in a company's stock and it performs well, you stand to gain in two ways. Firstly, the value of your stock can increase, leading to capital gains if you sell at a higher price than you bought. Secondly, some companies distribute a part of their profits back to their shareholders in the form of dividends. This could provide you with a steady stream of income even if you decide to hold on to the stock. While the risks associated with stock trading can be daunting, they can be mitigated. A well-diversified portfolio, a clear understanding of the markets, and a disciplined investment approach can go a long way in managing these risks. Remember, every investment carries some degree of risk. The key is to understand these risks and manage them effectively. Investing in the stock market isn't about making quick money, it's about investing wisely, understanding your risk tolerance, and making informed decisions. Balancing the risks and rewards is a key part of successful trading. Ready to dive in? Not so fast. The stock market is not a sprint, it's a marathon. And in this marathon, the key to success lies in a well-thought-out strategy and a great deal of patience. It's easy to get swept up in the excitement of potential profits. But remember, hasty decisions often lead to regrettable outcomes. Think of your trading strategy as a roadmap. It guides you on your investment journey, helping you navigate through the ups and downs of the market. It's a plan that takes into account your financial goals, risk tolerance, and investment horizon. Your strategy should be specific, realistic, and flexible enough to adapt to market changes. However, a strategy alone isn't enough. You also need patience. You see, the stock market is a dynamic entity. It's constantly changing and evolving. It can be tempting to react immediately to every little fluctuation, but often the best course of action is to wait. Wait for the market to stabilize. Wait for a better opportunity. Wait for your investments to grow. Impulsive trading can lead to losses. It's a common pitfall for many beginner investors. They see the market moving and feel the need to act quickly. They buy high out of fear of missing out and sell low out of fear of losing more. This is where patience comes in. Patience allows you to resist these emotional impulses, to stick to your strategy, and to make decisions based on logic and research, not fear or greed. So before you jump into trading, take the time to develop a solid strategy. Do your research. Understand the market trends, the companies you're investing in, and the risks involved. And once you've made your plan, be patient. Wait for the right time to trade. It may not be as thrilling as making split-second decisions, but it's a far safer and more effective approach. Remember, patience is a virtue in the stock market. So, are you ready to start your journey in the stock market? We've covered a lot of ground in this guide, all aimed at preparing you for this exciting venture. First, we demystified the stock market, explaining its workings and its role in the economy. Then, we delved into the process of stock trading, shedding light on how to buy and sell stocks and the factors that influence these decisions. We also highlighted the risks and rewards inherent in the stock market, emphasizing that while there are opportunities for substantial gains, losses are also part of the equation. Lastly, we discussed the importance of having a sound strategy and exercising patience. Trading stocks is not just about making quick bucks. It's a long-term commitment that requires understanding, strategy, and patience. Remember, the stock market isn't a get-rich-quick scheme. It requires time, effort, and a lot of learning. But with the right approach, it can be a rewarding venture.